Again, I'm Joe Spearman. I am an entrepreneur based in Sacramento, and I moved here. Next month will be 2 years after living in Austin for some time. And I was introduced to Vanguard and Next City many years ago. Big just student of cities and urban planning, like without pursuing it professionally. And when I was living in DC in in the 2000s, was selected in the first class in 2009 there in DC. And then I literally moved back to Austin where I went to college, January of 2009, and to pursue entrepreneurship. And at the time, my first idea of entrepreneurship was just pursuing my interest and my passions. And so the first thing I did was I had a sneaker boutique at City. If you've been to Austin, City Hall is right downtown, and there is a brick and mortar retail space underneath the mayor's office, basically. And I owned a sneaker boutique underneath City Hall. And so I did that was my first business, and it was just a great place to be because it was like, here I am with this kind of cool shoe store, and then city council members, the mayor, and then also all these different people are coming in and out every day. And then from that, I developed a kind of a reputation in Austin to the point somehow that the CEO and founder of a tech startup in Austin spent many months recruiting me to come in-house to his startup, which I ended up doing. I closed my sneaker store. I went in-house to this startup, and I helped them go public in 2012. And then after doing that, I was like, okay, I'm going to go back to owning my own business, but I want to do something in tech. And so again, following my interest and passions, what I went to was travel. I was like, okay, I love to travel, so I love cities. So I started this company called Localer. I started this in 2013 in Austin, and then over the span of 10 years, we grew from Austin to 200 cities globally. And it was like locals, just interesting local people recommending their favorite bars, restaurants, shops, things to do in different cities. And this allowed me to travel the world. It allowed me to interact with a lot of small business owners in all these different cities. And this is a great 10-year run, raised $5 million, partnered with big brands like Nike, JetBlue, Match.com, Lyft, you name it. Really great time. But and after the pandemic, well, really during the pandemic, and throughout this time when I was in Austin, I was seen as someone who kind of sat in the worlds between nonprofit or tech and kind of the city. So all the time, I would literally personally go to the mayor's house and advise the mayor and city council members on different issues. I sat on the downtown commission for the city of Austin. I was the vice chair of the music commission for the city of Austin. So I was oftentimes bringing kind of a business viewpoint to these civic conversations. And during the pandemic, I really ramped up my civic engagement, served on a number of boards, and was really involved in a lot of city initiatives to the point where I eventually ran for city council in 2022. And despite losing that election, what it reinforced to me was that I really want to try to help solve like really big problems. And I realized that my experience was really unique because it's like there are some problems that government needs to solve, and then there are some problems that industry needs to solve. And sometimes they don't try to solve the same problems. And so you have this situation where you have Silicon Valley and oftentimes funding a lot of cool, interesting things like what I was building with Localer, which is just, it's really fun, but it's like a travel guide for all these cool cities. And this is like a cool entrepreneurial endeavor, but this isn't like a civic issue. Whereas when I was running for city council, I was trying to address civic issues, but bringing kind of like a business entrepreneurial lens to that. And over this time, after losing that election, I spent time just thinking about what I wanted to do next. And I realized that the thing that I really wanted to do was work on a problem that really needed to be solved, that cities could benefit from, that individual people could benefit from. And what that led me to was a lot of different data that I'll share here. So this is one thing. 42% of Americans don't have an emergency fund. And I was like, okay, that's interesting. And then also almost 60% of Americans can't handle a random $1,000 expense without going to credit card debt doing that. And this is my personal lived experience because I'm the youngest of three boys. I grew up with a mother raising us, single mother, three boys. My mom's never made more than $50,000 in a year. And we lived until I was 12, we were on food stamps, free school lunch, and kind of living check to check, week to week, hand to mouth. And that's how my grandparents lived. That's how my great grandparents lived. And so I just was thinking about this lack of savings, this lack of financial well-being. And simultaneously, um, I started seeing all this just massive wave of layoffs. So whether that's school systems, hospital systems doing layoffs, nonprofits doing layoffs, universities doing layoffs, obviously large companies. And I realized that there is this Venn diagram in which people have inadequate savings, and then also layoffs are happening. And it got me curious. And what I did when I was curious was I went to the source. And for me, the source was my mom. And my mom is the first person in my family to build generational wealth. And again, I told you she's never made more than $50,000 in a year. But when I was 12, she got her first salary job, and she lifted herself into the middle class. And I became the first person in my family history to graduate from college. The next year, my mom became the first person in my family history to buy a house. And years later, at 60 years old, my mom became the second person in my family to graduate from college. And now she's retired, and she literally just retired 2 months ago and moved to Kenya. So it's like she's having a life that no one in my family's ever had, and options no one has ever had, and so am I. And it's not from like growing up with privilege and wealth and all these different things. It's just through a lot of sheer grit, honestly, and luck. And so after talking with my mom, what I realized is that 8 years before she bought the house, she lost the ability to buy a house because she was impacted by a layoff. And that layoff, what it did to her is it quickly wiped through her limited savings, her down payment money. And then she went into more credit card debt, and then did things like what many Americans do when they're hard on financially, which is pull out their retirement funds or their 401k prematurely, and which is really challenging. And so what that led me to do was create a survey to just ask random middle class people like what their situation is. So we created this survey. We've now had 2,000 people nationally do this, asking them about their employment status, their history with jobs, with salaries, if they're renting or owning, et cetera, et cetera. And the main question that we asked is this: do you have adequate savings in the event of a layoff? The overwhelming majority of people do not have adequate savings in the event of a job loss. And when job losses are happening in industries that historically have been really safe, whether that's federal or city governments, universities, nonprofits, even just today, obviously, if NPR and PBS are to get defunded, that's thousands of people nationally who have had really steady, stable jobs that will possibly be impacted. And so from that data, basically, we learned that what we needed to solve for, what I wanted to solve for was helping people with job instability financially. And so we built this tool, and I wanted to take some time to walk through the tool with you, and then I'll answer questions after. So this is the product that we came up with, and let me make sure that you can all see my screen. Okay, great. So this product is called Safety Net. And what we basically figured out is that the average American person needs something that acts as savings and a form of layoff assistance. Layoffs can't be prevented, unfortunately, especially in this day and age, but they can be prepared for. And so what we've done is there's a lot of math that's gone into this, a lot of actuarial math. But in essence, it's a plan that is 3 years in length. You pay $50 to $150 per month. And in essence, what you're doing is you're contributing. So for 3 years, you're saving $50, $100, or $150 per month. And at the end of 3 years, if you have no job loss, then you get all of that money back plus 8.33% annual interest. So it's very high yield. It's like very high yield savings account. Think of it that way. But here's the wrinkle. If anytime in that 3 years, if you lose your job, then we pay, my company Tenure pays $1,000 to $6,000 in cash to you if you lose your job, or a 25 to 100% match of unemployment in your state if you qualify for unemployment. So the reason why I wanted to share this with you is because I'm sure you're all familiar with a lot of these pilots that have been happening around guaranteed income. A lot of different cities have, there's the initiative around mayors for guaranteed income. And what we're seeing with some of these pilots is that you have people like my mom, for example, who, let's say, will receive $500 or $1,000 a month for 12 months. And that's great, right? During that time, they're able to pay off debt. They're able to maybe even save some money and pay for things that they need. But then after that 12 months is ending, they don't suddenly still have 500 or 1,000 extra dollars per month. And if they experience job loss thereafter, then they're actually even worse off than they were before, because now they've gotten into a position where their quality of life has improved. But then when job instability happens, then it's a pretty big hit. And so what's happening is we've been reaching out to cities. A lot of cities have had, I'm sure some of you are familiar with maybe Cities for Financial Empowerment, or some of these projects in which dozens and dozens of cities nationally have developed financial empowerment centers, in which they are, in essence, trying to equip their residents with financial wellness tools, coaching, different ways to pay off debt, access savings tools, et cetera. So here in Sacramento, where I'm based, we're working with the city of Sacramento to craft out a pilot. And I'm really trying to use the guaranteed income initiatives as a pilot structure of saying, okay, the difference being that our product is not relying on taxpayer funding or even private donations. The customer pays let's say the $50 per month, but thankfully it's a savings tool. So the financial wellness is built into the product. They're saving each month. And the main reason that someone would need to access their savings is if they lost their job. If they lost their job, that's the number one reason that someone would need to access and utilize their savings. And so in this event, we have a product that basically allows them to access, like make a quote unquote claim, and receive $1,000, $2,000, or $6,000 in cash within 2 weeks, or some kind of match of state unemployment. And so our goal here is that we partner with cities, with counties, and we don't need money from the city. We don't need money from the county. What we want to do is just partner with cities, and usually it's their economic development offices, or if they have offices of financial empowerment, or if they have economic mobility centers. And we want to basically partner with the cities to inform residents, lower middle class residents, of the use case of this product, because basically cities understand that having their communities have residents that are financially empowered and have financial stability, that's going to be a good thing for the city all around. Higher home ownership rates, lower debt loads, et cetera. And so what we're trying to do is just get cities to utilize us as a resource as they're working on these economic mobility and financial empowerment initiatives. So right now we're actively talking with folks in Milwaukee, Minneapolis, San Francisco, Sacramento. And so that's one of the reasons why I wanted to come onto this call and just interact with you all and, see if any of you have interactions with financial empowerment centers or economic mobility initiatives in your respective cities, or you work in that capacity with an organization that does work with cities. So that's pretty much what I wanted to share. And I'd love to, answer any questions, share more about the product. And, our end goal is to allow middle-class people, especially lower income, lower middle-class people, to have a tool that is not dependent on their employer for economic well-being. Because what we found is that 85% of lower middle-class Americans, if they lose their job, they not only lose their income, they very quickly lose their health insurance. They lose any kind of, honestly, disability or life insurance they may have. And they also increased their debt loads pretty significantly. And so on the lower end, you get things like payday loans. On the higher end, you get things like very high interest rate credit card usage. And so we wanted to basically provide a tool that is, like, again, it's a tool. It's not an end all. It's not a silver bullet, but it is a tool that is unique and we feel like it can have government scale, but using kind of financial technology tools. So yeah, I'll open it up. I don't know if there are any questions or, oh, is there a format MOU contract with unions? Oh, I like, there's a question here about an MOU. Actually, that's what we're working on. We're actually working with Sacramento to try to develop kind of like a template MOU, LOI of sorts. They're working through a contract process right now with so typically the way that we've seen cities work with their financial empowerment efforts is, let's say they have a financial empowerment center. So oftentimes the city itself doesn't coordinate that center. Those centers are oftentimes contracted out to affiliate organizations or nonprofits in the community that do that work on behalf of the city, financial counseling, coaching, et cetera. And so right now, Sacramento's in the process of doing that contract right now, extending it rather. And once those contracts are finalized, then we'll work on finalizing our own MOU, LOI with the city. So yeah, that's exactly the stage that we're in. And that's why I say we're trying to use some of the templates from the UBI and the guaranteed income pilots, because those pilots were typically structured very similarly, where a nonprofit or a foundation was granting money to the city to execute these programs, but they needed the city's kind of like permission or partnership to ensure they could effectively identify and qualify people for the program. And so that's kind of what we want to do as well. And I'm actually surprised that you haven't heard about the financial empowerment conversation in Portland. I feel like that's a city that would be on that. But actually, when I look at this map here, it doesn't look like there's anything here in Oregon. So maybe that's something that could happen there. Those are the
Yeah,
I'm familiar with.
I would love to share it. We actually have a meeting with the mayor's office in about 2 weeks, and I think it's just like folks are calling it the doom loop. I think there's a lot of navel gazing, but I think this brings agency at an individual, but also at a community level that is so inspiring and exciting. So I'm really glad. I'm happily um, able to make the Zoom and learn a little bit more. The closest thing that Portland has is actually in the Housing Bureau, and it's the home ownership. Like basically, in order to get home ownership assistance from the city, you have to do financial. It's like basically like household finance 101, and people have kind of felt like it's condescending, some like paternalistic a little bit. But I actually feel like the way that you're approaching it is a lot more like financial independence, like big picture, like what do you do when there's volatility in jobs or industries, instead of like feeling like it's a condition on funding to jump through.
Yeah.
So, but yeah, I'm curious like your take on why you feel, or if you have a strong opinion about where it would be located within a government structure.
Yeah. So in Sacramento, we're figuring it out. And I have a parallel track happening here. We are working with this Office of Financial Empowerment, which is from the city manager's kind of side of things. Simultaneously, I'm working with an individual city council member to figure out if this is something that like more should come more from the dais. And so we're gonna figure that out. It's again, that's why I say it's a lot like the guaranteed income pilots, because a lot of cities, the guaranteed income pilots were initiated by specific elected officials who were like, hey, this is something that this other city is doing. I think we should do this as well. And then that one council member or mayor pushes it through to get it piloted. And then in some cities' cases, it was the city manager's office or staff that were looking at what other cities were doing and deciding to kind of steward it from there. So we're kind of doing a parallel track. And I think both channels work. The end goal for us is, ultimately, if, layoffs are happening all over the country, in all over in different industries. And cities understand that if they lose jobs at scale, even moderate scale, then they start losing residents. And so in a way, we want to put this product in the hands of the people who most need it, so that they're not making those decisions of like, oh, can we no longer afford to live here because I just lost my job, et cetera, et cetera. And I lived through my mom having to make those decisions. And to your point about the paternalistic piece, I'll tell you, my mom is the first person in my family history to own a home, and she went through one of those programs in Greenville, South Carolina, and she spoke very highly of it and was very grateful for that program. So even if people, people are always going to have things to say about various initiatives and programs, but the reality is if you're doing the work, then that's all that matters. I see that Nisha has had a question for a while, so I wanted to get to
Oh no,
hers.
I just no worries. I love this product. It's super interesting. I didn't know about it, so it's always fun to hear about new products. And I had a question and also a sort of a comment. So at Mochify, we've done like 20 guaranteed basic income programs, right? So we're a dispersing partner. We've dispersed and one for maybe not 20, maybe somewhere more than a dozen. But I think one of the things we've learned is that people do want to have a way to save, right? Like that's one of the biggest findings, right? People have that $400 at the end of 2 years to take into for an emergency or a job loss or reduction in hours and things like that. And so I think building on your GBI idea, it would be really cool for programs that do have those cash assistance if this is offered as like either a philanthropic kick-in or, hey, you're in this GBI program, it's going to end. How can we help you create a model wherein, you have a little bit of savings and, so you're getting $1,000 a month,
Yeah.
$50 a month. So I think that could be like a really interesting, cool idea. I know that you have 3 different tiers and you said it was for middle class professionals, which often isn't what GBI is get targeted to, but at the same time layoffs we're seeing across all economic sectors. So I thought that was a cool way
Yeah.
for like using the GBI stuff. And I think we're always as GBI program people and implementers trying to create an off ramp so that there's not this cliff, like you suddenly getting all this money and exactly what you
Yes.
said. So I think that's a really exciting thing to think about. This is a program that's helping people save and kind of an insurance. So I think that would be really cool. And if there's ways you want to brainstorm that or do that,
Yeah.
happy to do that more.
That's
Um,
great.
and then the second thing was just more like out of curiosity, as like somebody who would be like, oh, I should get this program, is like, how do you, what's your business model how does your business model allow you to offer that great like interest rate that is like way above the average and just just a little bit understanding how
Yeah.
you're structuring your business.
Yeah. So two things. So some of you probably know this, some of you may not. But the insurance industry, the number one word that drives the insurance industry is float. Float is the interest that insurance companies make while they're holding your premiums. So if you get a life insurance policy for a term life insurance for 20 years, if you don't die in those 20 years, you don't get the money back. But even on top of that, the insurance company is generating interest while they're holding your money. And so we make about 9.7 cents on every dollar while we're holding the money of the customers. And so that's how we're able to deliver that interest rate. We make enough float even in very high volatility environments. So our model allows us to handle about 2.5 times the peak layoff rate of the Great Recession. So a lot of risk. The national unemployment can go to 11%, and our math still works. And so that's why, like, I literally just yesterday finished a program in which Northwestern Mutual invested in us. And one of the reasons they invested in us is because they're really interested in that model because their products tend to be things around like life insurance and things like that. The other way that we make money is we have because of that survey that I showed you, we learn a lot of data about a very hard to reach customer. And we don't sell that data, but that data allows us to basically understand what products our customers should have that they don't currently have. So for example, only 18% of people that have a savings account have a high yield savings account. So it's like we learn that, and then we can say, and then we find out things like, okay, is this person more likely to use Venmo than Cash App? Is this person more likely to use SoFi than Chime, et cetera, et cetera? And those financial companies are willing to pay commissions to basically have understanding of like, okay, should we be targeting these kinds of customers, et cetera? But we don't actually sell the data. We just sell the information of like in aggregate. So that's another way that we basically make money as well, because we figured out a way that basically the legacy financial companies are not targeting the people that we're targeting. 85% of our customers are women and people of color. And those just aren't the people that a company like Northwestern Mutual or Wells Fargo even are focused on serving. And so we've basically said, hey, we're going to focus on these people. This is who our mission is aligned with. And then now some of the larger companies are saying, oh, that this is interesting. Like maybe those people need our IRA product or our 529 product, et cetera. Other questions? All right, I'm going to do this. I'm going to put my email in the chat. And please, if you're curious, you want to learn more, you want to have a sidebar, like I'm here. I actually do this too. I'm going to put my calendar in there. There's my calendar for the rest of this month. If you want to set some time to chat, I'd love to chat. Like we are very much in the like, let's talk to as many people as possible phase. Municipalities is an area that we're focusing a lot on. We're also talking to pretty much all the major labor unions. We're in talks with them all about making this a member benefit so that the labor unions themselves can basically have all their members have something like this in their disposal so that when layoffs happen in those industries that those people are protected to a certain extent. So yeah, we are very much interested in you know, having as many conversations as possible to kind of get this, you know, socialized. So thank you so much for the time. And yeah, I'm here.
Awesome. Thank you. I filled out the survey and I immediately got a $25 payment, which I very much appreciated. And we've introduced this to Next City, and it's something that we're strongly considering and hoping to be an example for maybe our payroll company that then will impact even, you know, I think our payroll company has 44,000 people enrolled. And so anyway, just from my personal math mind, I love this and thought it was super fascinating, and I'm really glad that we got to share this today. So thank you for that. And yeah, we can circle back to more questions at the end if we have time, but let's scoot over to Priya. Thank you.
Great. Thank you. Thank you, Joe. That was really interesting and I really appreciate that. And I am going in a very different direction. So buckle up. So I will share my screen. Just give me 1 second here. Let's do this. Okay. All right. I'm guessing everyone can see my screen. Great. Oh, but then I can't see these things. Hold on. Okay. Sorry about the tech here. Okay. Can everyone still see my screen, or is it smaller? I'm guessing it's smaller. It does look
A
smaller.
little smaller, but it's good enough if this has your prompts and all that jazz.
Yeah. Okay. So, today, I'm switching gears quite a bit. I'm going to be talking about, I'm excited to be here, and I'm just talking about more real estate, as it relates and translating nonprofit mission into bricks and mortar. So for me, you know, a lot of my work, and I'll do a quick slide on my bio, you know, really has been just helping these community assets that we all depend on, whether it is a hospital, whether it's a community center, whether it's a theater. You know, when we talk about those situations, even what Joe was mentioning in terms of layoffs, of looking to our community, looking to the nonprofits that oftentimes have to support us through these hard times, we often don't think about them from a bricks and mortar perspective. And so a lot of my work has been working with New York City and working on the consulting side, just helping nonprofits really real estate plan so that they can stay in the neighborhoods that they need to and continue to grow and develop. And a lot of my passion has been, how do we think about nonprofits as infrastructure? What does it mean to think about them as infrastructure? And how can we make sure that they are finding the sustainable steps and doing the work they need to do, even just on a planning level, to make sure that they are continuing to build mission-driven assets in our communities and helping those, especially during times of layoffs, especially the middle class now, helping provide the services that a lot of people look to and need for their day-to-day lives. So why am I talking about all of this? It's because I've done it, like I've mentioned. I worked for what's called the New York City Economic Development Corporation for quite some time. There, I helped a lot of nonprofits utilize a certain type of funding in order to build their projects, but really try to figure out how to build a capital stack and actually invest in real estate in a way that's sustainable and that aligns with their mission. I then moved on to Denham Wolf, which was a consulting firm that also looked at helping nonprofits build their assets. And then my role in particular was helping nonprofits partner with developers in a way that made sense to both parties, that empowered both parties, and that we can create mixed use assets that are really the most important things in our neighborhoods, not just 100 or so units of housing, but 100 or so units of housing alongside a mental health clinic, alongside a social services organization, or even alongside a religious organization being on the ground floors instead of just traditional retail. So how do we mix uses in a building, and how do we do so where the nonprofit isn't being screwed over and there's a way for both parties to win and be invested? So I guess generally I always hear common misconceptions when it comes to real estate and nonprofits. And I think the biggest one is always like waiting for some sort of crisis to happen. And so what oftentimes I hear when I talk to nonprofits about thinking about real estate, they think they think they have to wait until the building gets to a crisis point. They have to wait till something actually falls apart. And what I say is that it oftentimes will limit your planning and limit your options. And really, planning doesn't mean building tomorrow. It just means knowing that you're going in some direction, knowing that you're still thinking about the future of your organization, and knowing that you're thinking about this community asset generally as not just the programs and the staff, but also the building and the space that you're in as well. So small organizations need to think about it this way, long-term planning, but also when you wait for that crisis to come in order to start planning, you limit the number of options you have available to you in terms of like how to tackle that. And also the funding options you have available in terms of being able to tackle that. Construction can feel very overwhelming, which I agree with. Whether you are one of the biggest YMCAs in the world, all the way down to a small organization in the middle of nowhere, capital projects are overwhelming across the board. And so breaking it into phases with the right partners can help reduce this risk. And then finally, a lot of groups, there are a lot of public RFPs out there, and there's a lot of developers applying across the country to a lot of public assets that are now up for RFP, which is a request for proposals, as some of you might know. And oftentimes developers have to partner with a community entity. More often than not, they'll try to stick the community entity into the project. And the nonprofits usually drag along into the process. And so what we like to say is that, yes, you're working with a developer, they have a giant team, but at the end of the day, they will do what's best for their scope, and they'll do what's best for the part of the scope that's going to drive the most amount of funding. So having someone that looks out for your mission, but can translate it and speak the language of the developer, whether that's an architect or an engineer, building your own team, is just as important to protect your mission throughout which I'll show you later, the long life cycle of a development project. So these are just some common misconceptions I want to throw out there because I hear them almost often. And what we tell groups is that the planning piece of it is not shovels in the ground tomorrow. The planning piece can start today. And all of these are definitely triggers to just starting the planning process. And again, other tangible triggers I tell groups to think about. And especially if you are working at a city agency and you're hearing about a nonprofit, or, you know, you're relying on a nonprofit in terms of some sort of contract you're giving them, you know, when we see growth in program and staff and services, I've visited nonprofits where the staff has left an office because it needs to be used for the teens, or it needs to be used for another programmatic need, and they're on the ground with their laptops. Chances are that should be your trigger and sign that we are too big for our real estate, or that we need to start thinking about real estate. Also, keeping in mind, there's a lot of shifts that are happening in the industry that we see, whether it's trying to get more money off of space that you may have bought pre-pandemic that you're now trying to lease out, co-locating with another nonprofit, trying to get more visibility. Those are all also triggers for thinking about larger term real estate planning. And then expiring leases and property uncertainty. So what I like to say typically is that anywhere in year 2 or 3 in your lease, if you are starting to think about like real estate, you're starting to think about your next steps, usually around the 2 to 3 year point in your lease is when you should start looking at that lease and talking to your board and talking to everyone internally, and not waiting until the lease expires, but really starting to think at that point, okay, our lease expires at year 5, or our lease expires in the 10-year mark. Is this space meeting our needs? Is this a space that we can continue to grow in? What are the issues and concerns we have? Should we start talking about planning a real exit strategy once our lease is up? So using these things as triggers to help you understand maybe real estate is a conversation I need to be having right now. And then again, a lot of groups will tell me, and I've heard this often, and even agencies and other types of organizations that work with nonprofits will say, you know, even with these misconceptions, it's not like there's just money out there for everything. You know, sure, we have these misconceptions, or sure, we have these real like triggers, but you know, I don't know if I can still do this. Like, I don't know what this, like, I don't know if I can take this on, Priya. I don't know if this is like something we should be doing right now. And just another way I look at it is just like, these are just some general questions to ask as well. Like, this is the flip side. So what is the cost of doing nothing? One of the biggest costs for nonprofits, for sure, and any of these community-based organizations that you work with or interact with on a daily basis, a lot of them are going through a deferred maintenance cost, which means that leaky roof or that HVAC system that they have not thought about, that they're just trying to patch up and have it go by for just another season. That's only going to get more expensive to replace fully. And so that cost of doing nothing actually increases over time. And that's why it's something to think about as, yes, you're not spending now, but are you actually just delaying the inevitable later of spending much more money to actually fix the situation? Another quick thing is just, are we aligned internally on your space needs? Talking to your stakeholders, your staff, your board, everyone. I think alignment is really important, and that goes back to planning. Planning is not building. So being aligned early on around what your real estate goal is and what you're looking to do, I think is very important. It's similar to like, do we know the state of our facility? A lot of groups do not have the capacity nor the basic understanding, unfortunately, and across the board at times, of just generally what is their space, like what's behind the walls, what does their space look like, and do we actually know whether or not our space can withstand the next year? It seems like it can, looks like it, but have we actually looked behind the wall? Have we actually done the work to see, like, do we know the state of our facility? And are we actually gonna get surprised later on with a crisis, like I mentioned earlier? And then finally, you know, the right advisors and partners. You know, advisors and partners can be anyone, but it's really just someone who has the right technical help to help save you time and money. So that way you have a general, and that can be something as simple as an architect walking through. It can be something as simple as someone on the board who has the expertise to just do an initial walkthrough. Any early technical advice can really help a nonprofit save time and money later on, just to give them that sense of what they can expect when they're trying to take on a potential new project or think about real estate as it relates to their mission. So again, these are the types of projects that I've typically worked on, or that nonprofits often work on. Developer partnership is just coming up more and more, actually. And I'll go into it, there's a lot of reasons why, but your typical 3 that a nonprofit will need support on, and I know a lot of you work in the funding space and you work for city governments as well. a lot of nonprofits will typically need help in the first three, which is capital renovation. So think repairs, think upgrades to your HVAC or mechanical systems. Acquisition, some of them just need a new space altogether. That can also include a new lease, but typically their space needs have now just exceeded what they currently are in right now. New construction is very rare as well, but we added in because a lot of specialized, or what I say more custom built nonprofits and spaces, so theaters, cultural centers, oftentimes will have to just go right into new construction because there's not many theaters or really custom built spaces available. And then again, developer partnership is very interesting. We have a lot of public RFPs out there. A lot of them do have this requirement. Look for these sort of partnerships in order to win really lucrative contracts across the country. And so we see more nonprofits that are trying to partner with developers, and there's certainly benefits to that, but there's also just some risks and pitfalls to keep in mind and make sure that they're protected against before entering into those kind of partnerships. So typically a nonprofit finally will ask me, well, if I listen to you, Priya, and I actually think about this and I'm going to do this, well, where is the money for any of this? Nobody seems to be funding this stuff. And it's quite true. I mean, to this day, we do see a shift in private dollars, whether that's philanthropic, whether that's donations, going more into space and space needs, which is great, but I still think it has a long way to go. And that's the reason why I put the government in the middle, because more often than not, nonprofits across this country have to, and this is actually quite a wide range. So a great example is academia. Surprisingly, a lot of academic institutions will have to go to, whether it's the NIH, for example, federal funding, state funds, or city funds for the development, let's say, of new lab space or new classroom space, but then get flushed with money sometimes on the programmatic side from large pharmaceutical companies or other sort of like philanthropic and private donors, because the tangible wins for them are on the programmatic side. They unfortunately don't care about whether or not there's a working HVAC system. They just want to see the impact and the results and the metrics that usually come from the programs. No one often, or it's very rare, or it's getting hard. It has been harder for nonprofits to actually demonstrate that the space is as important in terms of executing on the projects and the programs that people want them to. And so more often than not, what you see is government coming in and providing funding for these projects. And so that's why they're in the center. It also means that government asks for quite a bit when they are funding these types of projects. And I would say more so in New York City and New York State, but across the country, when government is funding these types of projects or capital projects, they will ask for restrictions that can make it harder for a nonprofit to work with the other funders that they need in order to really bring a project to fruition. So government funding, it is, again, the largest catalyzing source. So more often than not, if a nonprofit can get some contract from the federal government, the state or city agencies, or just directly from a city mayoral entity itself, it can usually be very catalyzing. So they can leverage this to finally get maybe other private dollars into their capital real estate projects. But it does come with strict rules. So I put this picture in of like expectations versus reality, because I think more often than not, to this day, nonprofits get upset, but do think, okay, I've gone through this laborious process. I've put in an application. I have, given you 6 different versions of my tax ID. I have done all this work. I have done all this bureaucracy, and great, money now. And then the government, more often than not, will say, not quite. We need 6 to 9 other pieces of paper. We need to know X, Y, this. And so I put this picture in because every type of nonprofit I work with, from the ones that have used government money and government dollars the most, all the way down again to the smallest nonprofits that are just getting started, there's such a misconception around really how to get this public sector funding. And the reality is just that while you get through a lot of important hurdles, there's still just so much you have to do to demonstrate the need for this money. So what I tell groups always is that definitely celebrate the wins when you get through certain milestones in the public sector process, but keep in mind, because of the strict rules around this money, one, it has a real impact on your real estate, which I'll go into, but then the other thing is really around how much work you then have to do just to actually see that money in your bank account. There's a lot of great people in this world, myself included, who have gone through the process, who have seen the fruits of that labor, the merits of it in new community centers and new hospitals and new theaters. But again, it is such a difficult process that it is not for the weak or the faint of heart. And I think governments are great in terms of providing more money on this side of things, but just keeping in mind that, again, it's a long process. Impacts on your real estate. So I've seen this across the country, and I've especially seen it on federal dollars like SBA loans and HUD loans. They will restrict your real estate. So they will put some sort of lien or some sort of covenant on your property. They are like a lot of lenders. As all of you know, in terms of lending, and for some of you familiar with the world, they're going to give you money in exchange for putting some sort of restriction or utilizing some sort of collateral. Usually it's the project site itself. We've seen in our experience, and I will say in New York City in particular, that those sort of liens and covenants can actually depreciate a property quite a bit, such that by the time the group, let's say, has exited the term of the covenant or the lien, the property is depreciated sometimes upwards of like 30 or 40% from what the value it could have sold at. It's just because of how restrictive it is and how much it's limited in terms of the use. And then again, if you're selling a property that has a lien on it or has a covenant, that makes it even harder, especially in New York City, New York State, and a lot of like eastern states and northeastern states in particular. They do have use restrictions. So that means that if a Starbucks is coming in, Starbucks is now going to be running kids programs. Like Starbucks is now going to be running a swim program because it is restricting the use of the building. So it's something to keep in mind because they are the largest funding source in any capital stack for a project. They just have a lot of restrictions, and there is this question of how do you balance all those restrictions with the ability to leverage it to get more money, and there are certainly ways to do that. But it's just making sure that you understand what those rules and restrictions are before you bring in other lenders and before you start to work on building your capital stack for your project. Matching funds. So speaking of capital stack, really it's just loans and foundations. So tax credits, I think what a really great tool, especially in the United States, and I'm speaking for myself because personally I'm a Canadian and it's something that we've struggled with in terms of providing more tax rebates, but historic tax credits that are given across the federal and state agencies that regulate the national landmarks. I think that's really great as a tool. It's again, very tricky tax credits, and that's like a whole other can of worms that I'm happy to discuss if anyone has questions, but historic tax credits are a good tool to help maintain and maybe try to offset the costs of maintaining a historic property if you are in one. And then new market tax credits, as some of you might know, a tool that was founded in the mid-90s. It's really helped a lot of neighborhoods be able to develop some of these community assets alongside, banks that are getting tax credits in exchange for their investment in the properties. Foundations, these are more Northeast foundations, the Fund for the City of New York and the Robert Wood Johnson Foundation, but these are all the types of different matching funds that typically you'll see a nonprofit try to bring in as part of doing a capital project or doing some sort of infrastructure project. Individuals and gift donations are the hardest. They come in intermittently and interspersed, so it can be a little bit tricky to try to put them into your full capital stack. But again, depending on how, I guess, well established the nonprofit is and sort of what their audience is and their board is, we do often see, and more so, I would say, have been seeing a lot of just like individual donations, really exceeding quite a high amount that actually it could take up quite a bit of the remaining matching amount to like any city government grant, which makes it much easier because it's the least restrictive of the ones that I've mentioned. Yeah, and so finally, pitfalls and risks, again, restrictions, like I mentioned, all of these funding sources have different restrictions. Because government funds can't cover all of your costs, it means you have to work with different lenders. Some lenders are really savvy to some of these restrictions, especially on the housing side. But typically they might ask for other things that are different than what the government is asking for. So we oftentimes it is about finding the right technical help and expertise, and especially hopefully as on the city side to just be able to balance all these restrictions and make sure you're able to give what you can as a nonprofit in order to get these funding sources. I think I've more often than not have seen so many nonprofits try to balance different funding restrictions and actually give a property and say to someone that they can lien it, and turns out they can't, or give them their income and turns out they can't. And so I've worked a lot with nonprofits just to make sure they dot their I's and cross their T's on, if you are doing this and you're working with all these different people, let's make sure you can actually work with all of them. And if not, let's figure out where we can negotiate in terms of the collateral you have to give. And so I think, like, again, I think the other big thing is in terms of the timing as well. One thing that I try to do a lot, and one thing I think is really important, is really just who's going to come in first. And what we're seeing lately is that nonprofits, especially when doing these types of projects, just don't get enough money for the actual planning piece of it. So the pre-development planning piece is really key. It's what ensures the success of any of these projects. And having not only the funding, but also the funding come in early enough to allow them to plan, to even say things like, maybe we don't need to do a real estate project right now, or this is great, and 5 years from now, once we've done X, Y, whatever, we will then do this real estate project, is so important, because more often than not, nonprofits are getting so much money right now to build things without the money around planning how to build things. And they are oftentimes in the middle of projects and realizing, or even at the end of projects and realizing, there's a huge cost to maintaining some of these new assets, maintaining something brand new, that they're not able to afford being in those buildings. We've seen that a lot in New York. And so timing of funds, but also the type of funding that comes into a project, there's like pitfalls and risks around timing when there's a lot of money coming in, but it's not coming in early enough to really help you think about whether or not you should be doing this type of project. And again, the obligations of matching funds, like if you're working with a lender, you're working with CDFI, a lot of nonprofits still don't really recognize like the cost of like interest rates, the cost of, you know, any sort of monthly obligation on a loan or a mortgage. So it's things like that, you know, I've done a lot of work on helping nonprofits think about what are your obligations and are you prepared for it, not just in the life cycle of doing the project, but after that, once it's done and the building or whatever you've built is actually open and ready to go. And some groups just want to avoid that altogether and say, well, why can't I just partner with a developer? Developers need me. I can leverage the fact that they need some sort of community asset in this, that they can win this lucrative bid, or they, you know, they maybe get more, they get some sort of bonus in exchange of putting me in. So why not work with a developer? And there's absolutely justification for it. I mean, you know, working with a developer, you can access expertise. You know, development is not a nonprofit's mission usually. So working with a good community driven or sophisticated development firm can help organizations kind of utilize that expertise of real estate in a way that helps them and benefits them. Sometimes we've seen, maybe more in New York and more in California as well too, a lot of nonprofits, especially faith-based groups, try to become developers themselves. In my experience, it's rarely worked out. So we like to say to groups, like, avoid that mission drift. You know exactly who you are and what you do. Finding the right partners will help you execute this vision. You do not need to now become a developer yourself. Finally, mitigating risk. So the board should be concerned about what risks you take as an organization. So partnering with a qualified developer is like part of that mitigating risk, because it's inherent in developing property, and making sure that you're working with the right people and the right team. And again, planning for that in advance can help you mitigate the risk of what comes later on with the development project. And then the biggest one for me, I would say, is like financial resources, like we just mentioned. As we just said, it's very limited capital that's available with nonprofits for non-capital related activities, for things like construction and real estate. So one interesting benefit is that developers can provide that risk capital, that pre-development, some of those upfront costs early in the process to help advance a project. And so you can work with a development partner to structure in a way where you have the time to do the fundraising or think about your finances without having to risk any money up front and back-ending your funding. And a developer can do that. Why? Because they can be the partner that takes on that risk. There's obviously a cost to that, but there's also benefits for them, again, like we mentioned, because they are getting something out of it as well by having a nonprofit in there on their project. But I also warn people that the pitfall and the risk of development is the fact that this is a typical sort of timeline for development. It takes a really long time for these projects to come to life. And so something to always keep in mind when you're working with a developer is that it's not going to happen in the next 2 years or even 3 years. And usually it takes sometimes upwards of 5 or 6 years before you go into your brand new space. So one of the biggest risks for sure is just the timing around development projects now. So really, I just wanted to present all of this because, again, I'm passionate about nonprofits and reframing the conversation as it relates to how they are in our communities, not just from a programmatic standpoint, but from a real estate and construction and space standpoint. And there's a lot of nonprofits that do need to start thinking about construction. They do need to find the right partners, whether it's people in our alumni group or people that we know. And so I often like to do these presentations just to help nonprofits understand that, it's easy to delay planning because you might be scared, but planning or having the conversations or thinking about it does not cost anything. It's actually the thing that costs you the least in the entire real estate process. Really just thinking about what your space needs are and having those open conversations with your stakeholders can be so important. And that while there are a lot of funding options, really understanding and thinking about which ones are right for you and which partners can be right for you, whether it is funding options or developer partnerships, it's making sure it comes back to your mission. And there's ways to think about your space in terms of your mission. And there's ways to think about that, but more importantly, there's ways to make sure that your funding options and your developer partnerships and all these people that are going to come in are also coming back to supporting you and your mission and how to grow your mission. So yeah, that's all I have.